Hello everyone. Gold's biggest enemy right now is not war. It is not inflation. It is that government bonds worldwide are suddenly starting to offer interest. You heard that right. Japanese government bonds, UK government bonds, US government bonds, three markets that have accustomed global investors to low-interest money for decades, suddenly started soaring this May. On Monday, Tokyo's 10-year government bond yield surged to 5.5%, a level not seen for decades. London's 10-year gilt briefly hit 5.5.86, a figure last seen in 1998. Washington's 10-year U.S. Treasury yield also climbed back above 5.4%. Three different stories. But for gold, the outcome is the same. When risk-free assets worldwide suddenly start giving you 5.4 to 5.5 annual returns, who still wants to hold a zero-interest metal? This is the real reason gold is currently stuck between 6.5 and 6.5. It is not technical support or resistance. It is not moving average entanglement. Global capital is undergoing a reordering of seats not seen in decades. If you have been trading gold recently, whether long or short, you will feel a very strong sense of suffocation. It rises to 6.5 and cannot go higher. It falls to 6.5 and cannot go lower. It oscillates back and forth, trapping both bulls and bears. Many people think this is because of the fluctuating situation in the Middle East, sometimes peace, sometimes conflict. But if you only focus on the Middle East, you will never see the true picture of this game. In this video today, I will connect these three hidden threads from Tokyo, London, and Washington to tell you what is locking gold in, and more importantly, Thursday's PCE data might be the bullet that breaks this stalemate. Okay, let us start with the most inconspicuous but most far-reaching news this May. On May 2, just 2 days ago, Japanese Prime Minister Sanae Takaichi announced a $1 billion emergency supplementary budget. $1 billion, approximately 10 trillion Japanese yen, to subsidize fuel costs and ease the living pressure on the public. If you only look at the headline of this news, you will probably swipe past it. Japanese fuel subsidies. What does that have to do with me? First, what is the background of this budget? Takaichi herself contradicted her previous statements. She had explicitly stated that no additional spending was needed, but the Iran war pushed oil prices sky high, coupled with the continuous depreciation of the Japanese yen, leading to soaring import costs. She could not hold on. She broke her word. This in itself is a signal. When a country's prime minister has to overturn her own words to urgently spend money, it indicates that economic pressure has reached a critical point. But the most crucial part is the string of numbers that follow. Japan's general account budget for the downstanding fiscal year is ibai 10 trillion Japanese yen. Of this, bond interest and debt servicing costs alone account for 10 trillion Japanese yen a year. On-year surge of 5.5%, and this is based on a hypothetical interest rate of 5.5%. This is already the highest hypothetical interest rate in 10 years. The problem is, Japan's actual yields have already exceeded 5%. The 10-year government bond yield has surged to 5.5%, and the 10-year yield has also reached 5.4%. What does this mean? It means that the interest calculations made by the Japanese government itself have been pierced by reality. Any further increase in yields will force the Japanese government to seek additional funding sources, either issue more bonds or raise more taxes. And no matter which path is chosen, it will push yields even higher. This enters a self-reinforcing vicious cycle. The more yields rise, the higher the debt servicing costs. Requiring more bonds to be issued, more bonds push yields up further. This is not a theoretical deduction. This is a fact that is happening. So what does this have to do with gold? You need to understand a core transmission mechanism. Japan is one of the largest overseas asset holders in the world. Japanese insurance companies, pension funds, and postal savings banks combined hold approximately $1 trillion in overseas assets. For decades, these institutions have been doing the same thing. Because domestic interest rates in Japan are too low, close to zero, they heavily bought us treasury bonds, European bonds, and Australian bonds to earn interest differentials. This is what is called the yen carry trade. But now, domestic interest rates in Japan are suddenly not zero. 10-year yields are 5.5%, and 10-year yields are even higher. Moreover, the market's pricing probability for the Bank of Japan to raise interest rates in June has reached 5.2%. If the Bank of Japan really raises the policy rate from 5.2 to 5.0, then domestic bond yields in Japan will rise further. This means that these insurance companies and pension funds no longer need to go abroad to find interest differentials. They can get 5% or even higher returns domestically, denominated in Japanese yen, with no exchange rate risk. So, a capital migration of trillions of US dollars is underway. Japanese institutional investors are starting to bring overseas assets back home. Every repatriated fund means one less buyer for U.S. treasuries. U.S. Treasury yields are pushed higher, and the U.S. dollar is strengthened, and gold as a zero-interest asset is continuously suppressed in this process. At the beginning of Liaocaning Arshido, the domestic bond investment portfolios of major Japanese insurance companies, such as Dai-ichi Life, are estimated to have realized losses of approximately 1 trillion Japanese yen, about 6 billion US dollars. This huge loss forced them to strategically withdraw from overseas markets. They are not allocating, they are stemming the bleeding. When an institution's domestic bond portfolio loses 6 billion US dollars, it has no capacity to strategically allocate gold. It is busy recalling liquidity, reducing overseas exposure, and covering domestic losses. So, Takaichi Sane's Shujo billion US dollar supplementary budget, seemingly a fuel subsidy policy, is essentially adding fuel to this debt yield spiral. More fiscal spending, more potential bond issuance demand, higher yield expectations, more repatriation of overseas funds. And this repatriation, ultimately transmitted to gold, is one word: squeeze. If the story of Japan makes you feel a bit far from gold trading, let us look at a more direct one. On May 7, UK, Manchester Mayor Andy Burnham won the right to challenge incumbent Prime Minister Keir Starmer. He announced his candidacy for Member of Parliament, preparing for a bid for the premiership. As soon as the news broke, the UK gilt market exploded. The Shenzhen-year gilt yield reached its highest level since Liaocaning Ba. The Shenzhen-year gilt was even more exaggerated, once reaching 5.5%. The last time this figure appeared was in 1998. Why is the bond market so nervous? Because Burnham's positioning in British politics is a left-winger who is more willing to spend money. Investors' memories are very good. They still remember the mini-budget disaster of least trust in Liaocaning Arshiar. At that time, UK government bonds collapsed within a few days. The pound plummeted, and pension funds almost blew up. Nigel Green, CEO of the very group, made a very accurate statement. He said Burnham is the biggest threat to the gilt market among all Labour candidates. Investors will immediately associate his name with larger government spending and looser fiscal discipline. The bond market is still shrouded in the traumatic memory of Lynch, but the story has taken a turn again. Last week, Burnham publicly pledged to maintain existing fiscal rules, trying to appease the bond market. In addition, oil prices fell due to progress in negotiations, and UK retail sales in April plummeted by 5%, far exceeding expectations. May PMI showed that the private sector contracted for the first time in a year. Investors significantly cut their bets on interest rate hikes by the Bank of England. The Shenzhen-year gilt fell from 5.5% to around 4.85%, losing the largest single-week decline since Liaocaning Arshido. But none of the structural problems have been solved. The UK's fiscal deficit expanded to £6 billion in April, far exceeding the expected £6 billion, a record high for the same month since Liaocaning Arshido. Political uncertainty remains unresolved. Starmer is facing pressure from nearly Liaocaning Labour MPs to resign. Whether Burnham can come to power, and whether he will truly open the fiscal floodgates after coming to power, these are all unknowns, and as long as these unknowns exist, the UK bond market will remain tense. Gilt yields will not truly trend downwards. Have you noticed the story of the UK and the story of Japan are essentially the same? Expectations of fiscal expansion push up yields. Politicians urgently appease the market, yields briefly fall back. But the underlying problems are not solved at all. Then yields start to stir again. And every jump in yields drains global liquidity. It raises the opportunity cost of holding gold. Asia Times published a report a few days ago with a very direct title, Bond Earthquake Spreading from Washington to London to Tokyo is Disrupting Asia. The article quoted a sentence from Thorsten Sloke, an economist at Apollo Management: interest rates will remain higher for longer. Investors should plan accordingly. This sentence is short, but very powerful because he is not saying it might be high for a while. He is saying this is the new normal, you should change your plans. Now, let us twist the three threads together. Tokyo Sanai Takaichi's Shujo billion emergency budget continues to push JGB yields higher, and Japanese institutions' $1 trillion in overseas assets are starting to repatriate. London, political crisis pushes gilt yields to a new high since Itenjo, and Burnham's fiscal expansion risk is unresolved. Washington's Shenzhen-year U.S. Treasury yields are back above 5%. Hawks within the Federal Reserve are gaining the upper hand. The latest FOMC meeting showed a rare large divergence in recent years. Some members even openly opposed the tendency to cut interest rates. 3 countries, 3 sets of logic, but the results converged to the same point. Global sovereign bond yields are rising synchronously. When Japanese insurance companies can get 5% GDP domestically, UK pension funds can get 5% long-term gilts. And us investors can get 5% Shenzhen-year U.S. Treasuries, who still needs a zero-interest gold bar. This is the underlying reason why gold is locked between Sitianwubai and Suwabadin. It is not technical entanglement, it is global capital reordering its positions. Gold is not unwanted. It is temporarily not prioritized in this capital scramble. You will find that gold often shows a phenomenon recently. The situation is chaotic, but gold is May Arshado. U.S. forces just bombed Iranian missile launchers and mine-laying ships in the Strait of Hormuz. According to traditional logic, war escalation, safe haven assets should soar, right? But the price of gold actually fell by more than Baifanji that day. On May 6, a cruise ship was attacked in the Strait of Hormuz. On the same day, the ISM prices paid index broke out at Basis Saderno, the highest since April. Ardin. Two major positive news hit at the same time. According to traditional logic, gold should rally sharply. As a result, the price of gold fell by Baifanjadin der Nilsen. This phenomenon of not rising despite positive news was not present in the similar tense situation in Ardin. In that year, similar Hormuz incidents saw gold rise by Baifanjar in a single day. Why is it different now? Because in Ardin, the 10-year U.S. Treasury yield was only Baifanza to Baifanza. Holding gold had almost no opportunity cost. Now it is Baifanza Siderwu, a difference of 2 full percentage points. These 2 percentage points are the price gold pays for losing its safe haven elasticity. This change is very critical. In the past, the market always fantasized that the U.S. economy would cool down quickly and soon enter a rate-cutting cycle.